Hey guys, what's up? Alec back with the daily stock market, and look at that. We have a red day overall for the markets on Friday. Now, individual stocks and electric vehicle stocks like Rivian and Lucid are down around 6%, but overall it was a not too much of a red day. Most stocks were down around 1 or 2% in line with the overall market. However, in today's video, we're going to be going over some of the best dividend stocks to be keeping your eye on. First, we'll start off with a very popular dividend stock like Johnson & Johnson. Then we'll go over a dividend stock that's up 40% already this year. We'll even go over some dividend stocks that have dipped in value and could be a good time to be buying them. And we'll even go over some riskier dividend stocks. So we'll hopefully talk about 3 to 5 different stocks in this video. So without further ado, hit the subscribe button, hit the like button on YouTube specifically. Make sure you subscribe for the full length videos. And let's dive right into this video, starting off with Johnson & Johnson, number one. Of course, it has to be the top dividend stock that we're going to be talking about. Everyone knows them. Everyone loves them. And if you're a dividend investor, you're probably already investing in Johnson & Johnson. So let's do a brief recap on Johnson & Johnson. Down 7.8% in the year, by the way. We had them at $180 per share January 4th. And then we went on to see that downward movement of 15%. So that's why you have to have your price alerts set, because a lot of these stocks, even the very stable dividend stocks like Johnson & Johnson, can make a 15% downward movement in the span of around 3 months. So you have to have your eyes peeled. And then it went on to just bounce back around 10%, which obviously is going to happen for a great stock like Johnson & Johnson. And just recently, March 10th was one of the lowest prices that we saw Johnson & Johnson. So if you didn't buy at those prices, you did miss out a little bit. My price alerts are set around $150 per share. Okay, so under $150, under $155 per share is where I dollar cost average in a lot heavier. However, I am dollar cost averaging in for the long term, no matter what price Johnson & Johnson is. Now, if we scroll down, we can see that they are a 2.7% dividend yield, and they've been paying dividends very consistently over time and upping their dividends. So if you're a long-term holder of Johnson & Johnson, or you plan to be a long-term holder in the future, there's a good chance that the dividend will just keep increasing over the years, now at 2.7%. The PE ratio is 24, by the way, implying it is a pretty good deal compared to the S&P 500 and the broad stock market as a whole. We have a market cap of $431 billion. And the good thing about Johnson & Johnson, they're also very recession proof. They sell a lot of consumer staples, pharmaceutical product, med tech products, consumer health, skin, over-the-counter medicine, baby care, oral care. The saying goes, even in a recession, people are going to have to be buying baby diapers. Okay. And that's exactly what Johnson & Johnson sells. So just some quick points to go over. Bullish points. This was updated April 5th, by the way. Several of Johnson & Johnson's key drugs and pipeline drugs are specialty drugs that tend to carry strong pricing power as well as low regulatory hurdles for approval. Diverse healthcare segments help insulate J&J from downturns in the economy, offering a defensive growth opportunity with steady and likely growing dividends. The majority of J&J near-term patent losses are for products that are hard to manufacture, which should limit the intensity of the generic competition. Another good thing. Now, if we look at some bearish things very quickly, legal action regarding talc powder and opioid drugs could cost billions of dollars to create distractions for management. J&J's late-stage drug pipeline is relatively weak from the size of the company, which could create long-term hurdles for growth. Now, if we pull up J&J's net income year over year, we can see that it has not been super impressive, honestly. Okay, it's been pretty stagnant. In 2015, they reported $15 billion in net income, and in 2020, they're reporting $20 billion. So not much growth. You're not getting crazy growth from this company, but you're getting stability. Okay, so if you're looking for a huge growth company that's going to grow by hundreds and hundreds of percent, J&J is not the stock for you. But if you're looking for a consistent dividend with a stock that could easily grow around 5 or 10% and outpace the market, the S&P 500 possibly, then the J&J might be for you. Okay, now in 2016 we saw the total revenue 71 billion increasing to 94 billion. So it's good that we're seeing that steady increase, although it's not a crazy increase. We also see that the balance sheet is under control with only 60% debt to assets. So it's a great thing to see. J&J is not going out of business anytime soon, and they're one of the most stable stocks, dividend stocks on this list. Okay, next up, let's talk about FedEx at $230 per share. Okay, in the past month, now they are up 20%. And this is the stock that I was talking about, the dividend stock that is up a crazy amount on the year. Now, if you take January 1st as the start date, we can see that FedEx is up 30%. But if you go back a little bit further than that to September, we can see that they're already up 60% from lows. So they've had a huge, huge rally. This is a stock, if you've been following the channel for a long time, you know I've been talking about, especially at those 2022 lows. So anything under $175 per share, I'm going to be loading the FedEx on. Set your price alerts because, you know, you can't keep an eye on every single stock. So that's why price alerts are the best. Now, during the pandemic, we did see the stock rally 155% to $314 per share. They were at $123 per share. They almost revisited those levels, going down under $150 per share very briefly, but then bouncing back up. So if you missed the boat on FedEx and you want to get in under $200 per share, there's going to be a good buying opportunity in the future. Just be patient. $200 per share, $195, but $175 is the best place I personally want to be buying. Now, they have a dividend yield of only 1.9%, by the way, but they made this list because the dividend yield is not only the most important thing, it's just one thing to consider when looking at a dividend stock. You also want to consider how much the stock's price could raise in the next 1 to 2 years of you holding it. So, for example, if FedEx goes from $230 per share to $300 per share, you would see a nice gain of around 30% on the stock price, plus an additional 1.99% from the dividend yield. So think of the dividend yield more of like a bonus and not like the end all be all just because, oh, it has a 6% dividend yield. It's the best dividend stock in the world. Okay, get out of that mindset and start looking at the company, the stock, a good company, a good stock like FedEx, okay, or Johnson & Johnson, and then look at the dividend yield secondary, okay? Now, if we bring our eyes up to the PE ratio, they're an even better deal than Johnson & Johnson right now, and they're an even better deal than the S&P 500 as a whole. They're under 20 on their PE ratio, implying at $230 per share, FedEx is a steal. But let's look a little bit deeper into that. Now, real quick, some bullish things to consider on FedEx. During nearly 5-decade history, 50 years, FedEx has weathered multiple economic cycles. While short-term results may suffer, the company's powerful parcel delivery network is firmly established. FedEx's massive package sortation footprint, immense air and delivery fleet, and global operations knit together a presence that's extraordinarily difficult to replicate. They have a huge competitive, durable advantage that Warren Buffett always talks about. And also, despite near-term normalization of lofty levels, FedEx U.S. ground and express package delivery operations should enjoy positive long-term tailwinds from e-commerce growth in the next few years as online people are continuing to buy more and more online. We're not at the peak of the e-commerce cycle yet. Every single year, more people are turning to online shopping, and FedEx is just going to be a benefactor from that. But let's pull up FedEx's net income and total revenue and see what's going on. We'll even take a look at their balance sheet. Okay, in 2017 we saw the net income at 3 billion, and in 2021 we see it closer to 4.9 billion. On a quarterly basis, now the most recent quarter was 771 million, with Q3 2022 being one of their biggest recent quarters, and that was 1.1 billion in just net income. Now, if we head over to the total revenue, we can see a steady increase, growing almost double digits every single year. They're growing a little bit slower in 2018, 2019, and 2020, but 2021, 2022, we see that 21 and 11% growth. So it's really good to see. And if we go all the way back to 2016, we've seen that total revenue almost double. And 2016 is not even that long ago. So think in the future, if you plan on holding this stock for a super long time, the total revenue can keep growing, the net income can keep growing. Now, the only thing that's a little bit concerning is the balance sheet. It's getting a little bit higher. Okay, in 2018, we saw it closer to that 62% debt to asset liabilities. Now we're seeing it closer to 70% and above 70%. So we really want to keep an eye on FedEx and make sure they are getting that balance sheet under control a little bit more. I mean, it's not even out of control yet, I would say, but it could definitely get to that 80% range and higher. So with all that being said, I think FedEx is a great stock to be dollar cost averaging, even at the current price. $95 per share is going to be a little bit more attractive, but $175 per share or lower, I think, is a sweet spot for FedEx. And the last dividend stock that we'll be talking about is Ford Motors. It's an oldie but a goodie. Okay, in the last month, it has been rallying a little bit, up 9.9%. And in the last year, they're down 18%, by the way. So let's go over if it's a good time to be buying some bullish things, some bearish things. We even see a 52-week high closer to $16 per share. So if Ford Motors did end up rallying to 52-week highs, then it would be around a 30% gain even from current prices. However, in the last year, we can see a bearish pattern forming. So it falling to the support of $10.95 per share is highly likely, and it falling even lower and breaking that support is highly likely as well. Here you can see it touch the support 1, 2, 3, 4 times already, and it's making a downward triangle in the last year of the pattern. So we could see Ford easily at $11 per share, easily at $10 per share. And in my opinion, I think we'll even see them again at $9 per share. So that's where I want to be loading up on Ford Motors, by the way. If we continue to scroll down, we can see the market cap is still fairly small. If you're comparing it to something like Tesla, okay, the PE ratio is negative, meaning that it has been reporting negative EPS or negative earnings lately. And why we're talking about them and why they're on the list is because we see that it has a dividend yield of 9.5%, which is a huge dividend stock, and it's the biggest dividend stock on this list. Okay, but if you buy at $12.50 and in the next year it goes down to $9 or $8, or it even hits a 5-year low of $5 per share, then that 10% gain isn't really worth it. So where Ford Motors is more justified is at a price point of $9, definitely under $10 per share, implying around a 20 to 30% downward movement still able to happen in 2023 for Ford Motors. That's what I'm at least doing. It's not financial advice. By the way, if you are a dividend investor, the best thing you can just do is dollar cost average in for the long term. But if you're trying to get a little bit more bang for your buck, Ford Motors, definitely a good deal under $10 and closer to $9 per share. Now, as we scroll down, we can see some bullish things to consider on Ford Motors. This was updated April 3rd, by the way. Ford has tried to remove some administrative layers, and we like the CEO Farley's aggressive move into electric vehicles, something the company was slow to do in the past. So right now, Ford Motors is getting extremely passionate and really revolving more of their business plan around electric vehicles, which could be a good thing for future or long-term investors, dividend investors. Okay, Ford is focusing its investments where it gets the best return, which is why mostly exiting North America car segment and production in South America is the right move in our opinion. Okay, so moving to South America is definitely a good thing and a bullish thing. Ford's turnaround will take lots of time due to many restructuring projects around the world, but so far the international business seems to be getting better on Ford Motors as well. Some bearish things to consider is Ford stock can sell off heavily on macroeconomic fears, even if the company itself is doing well. So that's something to highly consider. Remember, that's why I think even without even macroeconomics, just looking at technicals, I think it's going to drop to around that $10 per share. So if macroeconomics get worse and a recession happens, fears happen, okay, then Ford Motors is going to be falling probably faster than the S&P 500 is something to consider. So it's not like a safe dividend, it's more of a risky dividend. It takes significant investment to fund growth in the auto industry, which limits potential margin expansion. Long-term profitability could be hindered by unions, which traditionally have wanted their share of the pie. The non-unionized import automakers in the US do not have this problem, something to consider, like Tesla. The auto industry is very cyclical, and until recently, Detroit automaker has been losing significant US market shares to foreign automakers for years, like Toyota and Honda, for example. So if payday comes, for example, and I get $1,000 that I can put in the stock market, Ford is going to have to do a lot to convince me to spend that $1,000 with Ford Motors instead of, or alternatively, spending my $1,000 on something like Tesla stock. Okay, I typically would always reach for Tesla stock, but Ford at these lower valuations and even under $10, closer to $9 per share, with a 10% or 9.58% dividend to be exact, is getting more attractive and more attractive as the price gets lower and the share cost per share gets lower as well. Okay, so let's pull up their income statement and their balance sheet. And this is where it gets really interesting and you realize how risky the stock is. Now, if we pull up their net income and we look at an annual chart, we can see in 2018 they had 3.5 billion in net income, which is really good to see, but that was actually down 50% from 2017. If we move over to 2019, we see their net income was only 179 billion, and then it fell to negative. They were negative 1.28 billion, which is a huge fall from 2018. Okay, now this was the pandemic fears. Less people were buying vehicles and more people were probably leasing, which didn't benefit them as much. But in 2021, we saw a huge bounce back on net income with 17.9 billion. And if we go back years and years, they never really had a quarter or even, a full year as big as they did in 2021. So no doubt the prices could be inflated because of that awesome year they had in 2021 with 17.9 billion. But if we fast forward to 2022, we went on to see them lose an additional 2.1 billion, which is very bad news. And if we look at the quarterly, it's really not getting better for 2023. Here we see them negative 900 million in one quarter. And then in 2022 Q4, they were negative 1.2 billion in just one quarter. Keep in mind, this is a quarterly graph that we have pulled up now. Now I'm going to change it back to yearly and go over to the total revenue. Okay, the total revenue is basically stagnating at around 150 billion, and that's been happening since 2014. Very consistent with the revenue. Not much going on in that spectrum, but hopefully that electric vehicles could push their total revenue higher. They really have to figure out a way to get that net income a lot better. Also, if you are a Ford investor, it could be worth it to look into 2021, into their earnings statements and see why that was such a standout year and how they were able to have 17.9 billion in net income. Now, moving over to the balance sheet, Here we see that their assets and liabilities are above 80%, which is a thing I really don't like to see on a company, and it's a huge red flag for me. So this is something I really don't like. Ford stock is not a safe dividend. It's not like somewhere where you just want to park a bunch of money and watch your dividend come in. Okay, typically also like we discussed in the beginning of the video, when they have the higher dividend yields like a 9.5%, it's typically a riskier stock. So keep that in mind before investing in Ford Motors. So I hope you guys really appreciated me taking time out of my weekend to make that video for you guys, the best dividend stocks. And if you want a part two and hear about the other dividend stocks that are on my watch list, drop a thumbs up on this video. Make sure you comment below. And if you want to join the close friends list where we post exactly what I'm buying, what I'm selling, how much I'm buying, strike prices, expiration dates, swing trades, option trades, long-term trades, you can see all my trades. Go ahead and message me at the Daily Stock Market here on Instagram. Almost 200,000 followers now. We have a huge milestone. Also click on success number 8, success number 7 in the highlight section, and you could read through some of these positive testimonials. Thousands and thousands of dollars made every single day in the close friends list and the Discord. Another $1,000 day before lunch. Feels amazing, up 162%. 600% gains, knocked it out of the park. If we even hop in my Discord, here we can see that everyone had an awesome Friday. We actually have an AI trading bot in our Discord, and this member was 5 out of 6 for the bot this week, the AI bot, calling out options, strike prices, expiration dates, 83% accuracy on that bot. Another member and a top trader here, we have Spy Player, who just plays Spy all day long, up 253% on Friday. Decent day, didn't have to go down to go up this time, just scalped a few times, and it was up 6% on the portfolio, which was only $42. So smaller accounts are welcome as well. We have Canadian students, we have people from all over. So if that sounds like something you're interested in, go ahead and message me on Instagram. Other than that, thank you guys for all the love and support you've been showing on YouTube and Instagram. Make sure you share this video with a friend if you think that they will find it helpful. As long as you keep liking these videos, I'll keep making them for you on YouTube. It's the only place to find the full videos. Thank you guys for the love and support, and I'll see you in the next one. Remember, don't time the market, buy the market. Peace.